Good morning, everyone, and thanks for joining us today for the third quarter update of the Nedgroup Investments Rainmaker Fund. My name is David Levinson of Nedgroup Investments, and joining us from the other side of Table Mountain today, I'm very happy to have Anthony Sedgwick on the line from ABAX Investments, and is the portfolio manager of our Rainmaker Fund as well as the Entrepreneur Fund. And of course, this quarter is going to take on a slightly different tone, as many of you are aware. On the 1st of September, we opened up the Rainmaker Fund to its 30% offshore allocation. So Ant will touch a little bit in terms of what they've been doing in the last month and a half from stock selection and adding to the portfolio. The team at ABAX have been managing a global equity fund for almost 7 years now, and they've demonstrated their capabilities in terms of global stock selection as well as portfolio management. Of course, you are probably well aware of the format of these sessions. It will be roughly 15 to 20 minutes of presentation from Ant. On the right-hand side of your screen, there is a Q&A function, so please do post your questions during the course of the presentation, and at the back end, I will then ask Ant as many of these as we can possibly get through. So without further ado, I'd like to hand over to Ant. Thank you, Ant.
Thank you, Dave, and good morning, everybody. Thanks for the introduction. We've got a short time this morning. I don't want to try and cover too much, but certainly looking forward to talking about the significant change in the mandate that we've been able to take advantage of from the beginning of September. If we look at the first slide, just a very quick update on where we are in the domestic equity market. I don't need to tell anybody in this audience it's been a pretty unexciting place to be invested for quite a substantial period of time now. If you look at the chart that you see in the background there, that's just the JSE All Share Index going back 10 years. The red line that I've drawn there is just at the 50,000 level. I think we closed last night at around 55,000. You can see for over 6 years now, we've effectively been moving sideways. And then in the more recent times, I've highlighted just the 30% drop that we saw in response to the explosion of the COVID pandemic worldwide, which started in February of this year, 30% drop. But we've also seen a substantial recovery from the low point, which was recorded, I think, on the 19th of March. For the last quarter, we've effectively been going sideways. The table that you can see there just shows the year-to-date numbers. You can see the all-share index is now down 2.5% year-to-date, and that within that, there's been a massive divergence in relative performance. You can see the resource sector over on the left-hand side, up just under 12%, has been the standout and really only place that there have been any decent returns to be earned. Both the industrial sector barely up, largely driven by the very heavy Naspers weighting, of course, and a very long list of companies that have underperformed. Financials have been very weak. You can see the property sector on the far right-hand side, the standout underperformer down 46%. And unfortunately, mid and small caps, I've got a slide at the end for Entrepreneur, have also been a very neglected sector and big underperformers for the year to date. If we look at Rainmaker specifically, I look back, over the last couple of years, what has helped and what have been headwinds to the performance of the fund. Couple of positive points I'd note is the Naspers process combination with the unbundling of process out of Naspers. It's now 21% of the portfolio. It's been a very strong performer. I can assure you it's not a position that we take lightly, and are very, very aware of the size of that position and worry about it a great deal. Clearly, it's driven by the prospects for Tencent. Unfortunately, the market's still not prepared to attribute any value to the rump of the portfolio of assets that are held, although there have been recently some encouraging signs that management continue to prioritize and are very aware of this issue. It's the main bugbear for any investor, and are committed to taking further actions to try and unlock that discount. BAT and Rainet, off a low point in Q4 of 2018 for tobacco, a time of great uncertainty, have staged a bit of a recovery. We have had substantial exposure to the resource or the basic material sector, as it's called today, primarily through Anglo American and BHP. Cumulatively, those are more than 10% position in the portfolio and have been for some time. And we've preferred those diversified miners to the mining producers, the direct mining producer exposure, which is something that we're always a little bit circumspect about, considering the amount of risk a pure mining producer, particularly a precious metal miner in South Africa, are exposed to. Having said that, it's not a sector that we dismiss simply because there's a great deal of risk and there's a great deal of unpredictability. And for the last 6 months, we've had the largest exposure to direct mining producers in South Africa than we've had in this portfolio, if I think back over the last 20 years. I think this will come back to be highlighted in a subsequent slide. We've had almost no exposure to the property sector, a fraction of 1% in Growth Point, which has been reasonably defensive, but really none of the others. We haven't owned any of the other stocks in the sector at all at any point in the last 10 years. So that's been a good thing in the context of the prior slide that I showed you. And we've had very limited exposure to discretionary consumer retail businesses, which we continue to feel will face tremendous headwinds, notwithstanding the short-term assistance they may get from the extension of the emergency social grant that Cyril Ramaphosa announced yesterday. So while those were all good, unfortunately, we didn't get it all right. Some of the positions that we had that have detracted from our performance been on the bank side. So we'd had quite a relatively big exposure here at the end of Q1 of this year, prior to the COVID crisis, where valuations we felt had got to a pretty attractive level. We were expecting not very exciting, but gradual economic growth out of South Africa. Clearly, the COVID pandemic has tipped that on its head completely. We did react quite quickly and have reduced our overall banking exposure and focused it purely into the higher quality names that we have higher confidence in. But all of the entire sector has been very hard hit and has not staged much, if any, recovery yet. While you see the market has recovered quite substantially, you've got the banks and the discretionary retailers and the property stocks, even worse, continuing to languish at very low levels. We also had some Sasol exposure, which we bought thinking, or on our analysis, that the firm was through the worst of the difficulties of the Lake Charles project implementation. Unfortunately, even though it was 90% complete, the management of the company managed to screw it up even further, and that has detracted from performance particularly in Q1 of this year. And as a domestic equity fund, which Rainmaker has been 100% domestic equity up until the 1st of September 2020, we did have, we have to, build a diversified portfolio. We'd been in more defensive things like that we felt will survive, that occupy niches where they're quite dominant, and the limited exposure. The entire sector has been very severely negatively affected by COVID. And we haven't managed to escape it completely, despite being in what we considered relatively defensive positions. And the notable ones there were CUP and Bidvest. So where are we now? This is an update of a slide that I think hopefully many of you have seen already before. A message we've been communicating in that first list of things. What do we need? For prospects for domestic equity to be getting a little bit more exciting and a little bit more positive, and what were the problems that we were facing? I'm not going to ask you just to glance through that list. I think you've seen it before. For 2018 and for 2019, these have been issues that have worried us. These have been things we've been looking for, but have found no evidence of improvement in. And then, although since Cyril Ramaphosa's election as head of the ANC at the end of 2017, we had been starting to see some, gradual signs of gradual improvement, absolutely glacial, unfortunately, in the rate of progress. And pre-COVID, at the end of Q1 of 2020, we were seeing mixed signals. In some things a little bit. For example, on the corruption accountability, we were seeing a little bit of activity happening in the fixed investment space, but nothing to get excited about. And of course, with the advent of COVID, all of this has largely been turned on its head. I don't know how many of you have studied the detail or have spent any time around the economic recovery plan. We've been engaged with Business Unity South Africa on all of the detail of this. There's encouragement in that there seems to be, for the first time, a sort of a deep understanding and acknowledgement, both from the public, from the state, from business, and from labor unions, that this crisis has galvanized more action, a greater willingness to negotiate, a greater willingness to compromise on, for example, the state's very socialist agenda that they've had, for example, in dealing with public enterprises, which are many of which are in absolutely shocking states. But I'm afraid to say it's rather like Groundhog Day here in South Africa. As patriotically as we look for evidence of improvement and things going in the right direction, the reality is that very little rubber hits the road, and we would continue to err on the side of caution in that regard. As much as we want to believe that progress will happen, I'll only believe it when I actually see it. Turning then to some specifics within Rainmaker and the change in the mandate, which was effective, as Dave said, from the 1st of September. We're absolutely delighted to have this opportunity. We've invested very heavily in our global equity capabilities for the last 7 years. We've built a track record in a global equity fund that we're very proud of and working very hard at maintaining. The performance of Rainmaker relative to other general equity funds has been a huge frustration for us, in that the vast majority of the portfolios in that sector have been able to avail themselves of the 30% offshore exposure, whereas we've been completely tied to South Africa. You've seen what our domestic equity market has done relative to that. We've performed okay, but nothing too exciting. But if we'd had the 30% offshore, as most of the other funds have done, with global equity markets, particularly in the US, having done as well as they have, and of course compounded with the weakening rand, the performance of Rainmaker would look substantially better. The obvious question would be to say, aren't we making this change too late? Based on the comments I've just made, with respect to the outlook and the prospects for our domestic economy, we certainly don't think so. And we've taken full advantage of the rand, which is appreciated by 14% from its weakest point this year in April, where it got to over 19 to the dollar. We've used this period of the last 6 or 7 weeks. Looking at the details this morning, the fund is now 18.5% is offshore. How do we manage it? Well, it's not just 70% Rainmaker, 30% ABAX Global Equity Fund, and we don't want to use the offshore budget to buy rand hedges that we can do here in South Africa already. The good examples there being British American Tobacco and Naspers. We're not going to sell the Naspers and buy 10% offshore, particularly with the huge discount that's there. And that's reference also to the point of double dip. What do you get extra? You get direct exposure to our best international ideas. These are obviously going to be positions held also in our pure global equity fund, but a little bit more intelligently with respect to the composition and the direct holdings that you'll find in Rainmaker. Already, some of the names that are held in the portfolio are listed there: Amazon, Alibaba, Anhui Conch, which is the biggest cement producer in China, Microsoft, Samsung. I think you'll be familiar with those names. Moncler was a very interesting niche luxury goods business that has been a huge success for our fund, and which we're still very excited about how much it can grow. The rest of the names you might be familiar with, and I'm looking forward, together with Steve Minnar, who is our lead in the global equity space, sharing some of the details of some of these very exciting businesses with you on future quarterly commentaries and presentations. Where have we raised the money from to achieve this? Largely out of reduction of our bank's exposure, the little remaining retailers that we did own. There's no need to own an industrial holding company like Renewable, for example, which was sold out completely, and generally across the other local things. What largely stays the same is the holding in Naspers and Tencent, British American Tobacco, and we still have a very big exposure to the domestic basic materials sector, which we expect to benefit tremendously from a weakening rand and still stronger commodity prices. So looking at the fund and some of the substantial changes that you can see from a sectoral basis between July and October, so this is right up to date, this is not just as at the end of September, you can see the basic materials component remains largely intact, as does the industrial rand hedges, which is predominantly, as I've already said, Naspers and British American Tobacco. But you can see the domestic side, the left-hand side of that pie chart, the financials, domestic and other, and domestic consumer have all dropped substantially to make space for the global equity component that's come into the portfolio. Looking at the top 10 holdings between the funds, just a couple of points to note is you'll notice for the first time there's a direct name, Alibaba, which has come into the top 10 holding. I also can show you cumulatively we own all the platinum stocks. Cumulatively, they're 7.4% of the portfolio. You can still see the big exposure to Anglos and BHP. And the relative to where we were a few months ago, you can see the exposure to FirstRand, Standard Bank, and Sanlam are all substantially lower. Before we move on to questions, just a couple of comments on Entrepreneur. You'll recall from the second slide of this presentation that the mid and small cap space has been particularly hard hit in so far year to date. That's not really a great surprise to us, considering the decline in economic growth prospects that's happened for our domestic economy. If I look at the quarter, the standout performer has been our large exposure to Royal Bafokeng Platinum, as well as Afrimat, which is largely an iron ore producer. More than 50% of their profits come from an iron ore mine today, in comparison to just the pure quarrying business that it has been historically. And unfortunately, on the right-hand side, some of our domestic, more conservative businesses that we would expect to be quite protective, including Adcock and Santam, for specific reasons, have been a little bit weak in the last quarter. If you get the chance, I'd encourage you to read the Entrepreneur Q3 quarterly commentary, where we go into some detail around why we like both and continue to like both Royal Bafokeng and Santam in the portfolio. Naspers, as you know, is a peculiarity of this portfolio that is an historic situation, and despite our frustrations around the tremendous discount that's trapped in the structure, we are slightly more encouraged that before the end of the year we'll see another announcement from the company around a step aimed at tackling unlocking the discount in the structure. We remain hopeful, and we'll see whether that comes to fruition. So very, I know time is short with this thing, and I don't want to avalanche you with too much information, so let me pause there and see if there are any questions.
Excellent. Thanks very much for that thorough presentation, Ant. We had a few initial questions coming in regarding performance at the start of the presentation. You did touch on that in subsequent slides, but I think it's probably worth having a relook again. I mean, you made the comment about Rainmaker focusing purely on SA historically, and if we were to rewind sort of 24 months or 2 years ago, the Rainmaker was probably performing quite well in terms of its category and has really struggled probably in the last 18 months or so. And then another comment around the funds that have performed relatively well in that category that have been SA only focused. I imagine a lot of them were probably overweight, and a lot of their contribution came from the resource sector and more focused mining companies, whereas Rainmaker has typically stayed away from those and preferred some of the diversifieds. You did comment on adding a lot of the PGM basket stocks recently, so maybe talk a little bit to those comments around performance and maybe a sense in terms of comfort that incumbent investors can have in ABAX and the process going forward. Thank you.
Thanks, Dave. So I think those comments are entirely accurate. You know, if we'd had only Anglo's BHP, Naspers, and some gold shares and some platinum shares at very big exposures, we would look like heroes. I think that's not our approach to be that aggressive. We really don't like the volatility and the unpredictability of mining producers. You can look like a hero in gold shares one day and a complete zero the next. You know, having said that, we think that the platinum producers at the moment are printing money with the rhodium price, particularly where it is. They are, you know, cash is pouring into these businesses, and they're going to pay down the debt. I think for us, the interesting thing is going to be how they're managing costs when we next see them in the next quarter, which they've been notoriously bad at doing, and how much debt has come down. So for the time being, for us, are, you know, very aggressively positioned. You can see the weightings that we have now. I know that the funds that are, you know, at the top of the table have had, you know, multiples of that degree of exposure in their portfolios, and, you know, congratulate them on, you know, having had the courage to do so. You're never going to see that at ABAX. That's not our investment style. That's not our investment approach. We're more conservative. We build a more balanced portfolio where we have conviction. And I think we do have conviction. I think it's clearly demonstrated in those top 10 holdings. You know, you'll see it reflected in the portfolio. I really wish ASISA would split the general equity category into two, those that have international and those that don't. I really think it's a very flawed analysis to look at the performance across all of those funds, given the huge disparities in structure that exist and mandates. I understand that that's hopefully again a matter on their agenda, and that will, you know, allow investors to do a more intelligent analysis of that relative performance. And for the reasons I've given, you know, we remain very excited about you still wanting to stay with Rainmaker, and it now having this opportunity of having that 30% really gives us the best chance for the future. And I really don't think that it's come too late.
Great, thank you. And then just looking at that exciting global component that you mentioned, typically there are a few household names in there, your Amazons and your Alphabets, but maybe you can touch a little bit on something that the audience might know less about. I know you have a certain stock called Trixx, another one I think is called Tractor Supply. Well, I'll give you full license here to maybe talk us through the investment case behind one of the more interesting positions.
Yeah, I mean, I can get quite carried away here, Dave. So Trixx is a really exciting business. It's an American company that produces composite decking out of recycled plastic material. So in the US, decking around homes and commercial properties is extremely popular and very prevalent use of the material, and goes back a long time. The problem with wood decking is it requires a high degree of maintenance, and it has a limited, its lifespan is reasonably limited. This composite decking product, and it really, you shouldn't think of those sort of crappy park benches that we see in South Africa made out of recycled plastic. Go and have a look at the website. They have quite a wide variety of product, from, you know, super premium to a more value product. But it really has the look and feel of lumber. Point number one. Point number two, it requires no maintenance. Point number three is you can install it yourself, or you get experts in to do it. Point number four, Trixx is the market leader in the space. They literally cannot keep up with demand. As they add production capacity, it gets filled. The product in relatively short time is actually going to be available here in South Africa, and of course the input cost is low and practically infinite in supply. And the fact that it is coming out of it's recycled plastic that's being used from an ESG perspective, it's an extremely appealing product and an investment for us. The management team we're comfortable with. The inventory cycle and the cash flow cycle is very attractive. We've done well out of it, and I just wish we were buying it on a cheaper valuation. But the runway for growth for this business, we think, is still extremely attractive with many, many years to run. I look forward to, maybe showing you in one of these presentations a few more slides on it, or maybe Steve, who knows it even better than I do, should do that.
Okay, thanks very much, Ant. And then a question here around SA banks. You've historically held quite sort of strong positions in SA banks. I think you trimmed a couple recently, and dare I say Nedbank was one of those. But FirstRand has been a key holding for yourselves. I think Standard Bank is still in the portfolio. And the question is around, is it the right time to sell these banks? You did have that pie chart showing a slightly lower allocation to SA financials.
Yes.
So maybe talk a little bit to the timing of that.
Yeah, I think that's an excellent question, because you would say, why are you selling now? I think the first point I'll make is we still have a very big exposure. You can see that they're both positions in the top 10 holdings there. We needed to trim across all of the domestic side of things, which we feel is the right thing to do to start the migration to the international side of things. There's still an enormous amount of risk for the banks here in South Africa. That's why we focused just on the two picks that we have, Standard and FirstRand as the preferred ones. The valuations for all of them is very low by historic standards, but there's a great deal of uncertainty still around what the recovery pattern is going to be here in South Africa from an economic recovery perspective. And although they've all taken severe views now that we have IFRS 9 around provisioning for bad debt, it's still very uncertain about just how much bad debt is going to be experienced by the banks over the course of the next 2 years, and how quickly we will or won't recover. We acknowledge where the ratings are, we acknowledge where that points, we acknowledge how conservative these banks have been managed, in fact all South African banks, and how well we weathered the global financial crisis. But this is not the global financial crisis. This is worse from a South African perspective. It's hit the South African economy a lot harder than the GFC did, and but we think they will weather, and they will come through it all, and consequently why we do want to retain a reasonably large exposure, as we have, and you can still see them both there in the top 10.
Thank you, Ant. I haven't looked too closely at the markets today, but after Cyril's speech last night, I think the rand might be slightly firmer, so I imagine that the banks have maybe held up reasonably well. I do stand to be corrected there. The other question, which is another interesting one, you did touch on it a little bit earlier, but I think it's probably worth readdressing, is the Naspers position. I think it's roughly, you said 15% of the fund, and it's more a sense of how you look to play that position going forward now that Tencent is a potential investment opportunity, or is it a matter of complementing that position? And do you, in your view, would Naspers remain that material in the fund going forward?
So the short answer is, in the short term, yes. So Naspers is 15. If you add Process, it's another 5 or 6. So we're 21% in the combination. They're essentially the same thing, despite management's attempts to try and portray them as a little bit different, but they are essentially the same thing. The huge frustration is the enormous discount that sits there. I think, we feel Tencent, which has moved between 500 and 550 odd Hong Kong dollars a share, we think still has a very, very exciting growth future ahead of it, despite the scale that the business has grown to. And it really is enormous if you look at how big the business is already. But there are a variety of new angles that are already quite material, and where we see growth actually continuing to accelerate. This during a year where the company has already prospered enormously, being able to operate practically seamlessly through the COVID pandemic. So we remain very positively disposed towards Tencent. We do own it directly in our global equity fund, where we don't own any Naspers. So this is a more intelligent way of doing it, given Rainmaker's thing. We're not going to own 10. Obviously, if Naspers management, and we can all only hope and pray, the board came out tomorrow and said, we're going to unbundle the 10-cent shares to our shareholders, and then whatever's left will force the market to put a valuation on the rump, which, by the way, we think are pretty good assets, largely. And we'll get this, we'll get the sudden, spike. Then in that case, you definitely see a substantial, reduction in the size of the position, and we would then, probably want to own the 10-cent shares directly. But for the time being, given the discount, we're prepared to be patient and continue to agitate for change in dealing with the board.
Great, thanks. And you made a comment earlier about Trixx and using sustainable products in terms of decking, and we've had another question come through here. I know you guys performed really well in our annual sort of ESG, or responsible investment review, and the comment was around plastic as a I guess an alternative for binding as opposed to bitumen in the tar process.
Yeah.
At Nedgroup Investments, we also get a fair amount of questions around renewable energy and how South African investors can get access to the renewable energy program in South Africa, and it's currently been quite difficult. So Cyril did announce, I think it was 12 gigawatts or 12,000 megawatts additional to the grid, which I imagine a large chunk will come from the renewable space. It still remains quite difficult for investors to gain access, and how would they go about doing so? Maybe the banks would be an avenue for that, and is it material in the banks' lives?
It's not really. It was interesting. Overnight, I saw Standard Bank had responded to a question around the, what proportion of their loan book is exposed to fossil fuel consumers, whether it's coal miners and that, I think the number was 6.5% of their loan book. They've got another 7.5% exposed to agricultural activity, which is obviously at risk from climate change, from flooding and severe weather events, but only 0.8% of their book exposed to lending to renewable energy producers. So the industry is still largely in its infancy here in South Africa. We expect it to grow substantially. Clearly, with the big electricity consumers, like the mines, for example, for them now to be able to self-provide is an extremely exciting development, both for shareholders and obviously for those businesses themselves, that they become less reliant on Eskom. But you're right, Dave. There's very limited exposure. The one which we do have is a firm called Raubex, which has done a lot of building work. So I think that's the first opportunity, is as these things come to the market, they're going to have to be built first. And there's extremely limited capacity in South Africa, given the decimation of our building and construction sector. Over the course of the last decade, or since its peak at the time of the 2010 Soccer World Cup. It's been absolutely decimated, as you all know. But there's a business called Raubex, which we do own in the fund, and we do own a bigger position even in Entrepreneur. And a big part of what they do, and where they've had a great deal of success, is in building these very large arrays for the solar plants, and obviously very steady bases and part components for the wind turbines. So in the short term, I think that's probably the best way to play it. But again, unfortunately, there's no direct way that you can do so. One of the positions we own in our global equity portfolio, and which we're hoping to introduce to Rainmakers, just had a very strong run in the last months, is a company called TPI Composites. It's an American business. It's the biggest producer of the turbine blades for wind farms in the world. It's had a bit of a difficult time, up and down time in the last couple of years around some manufacturing changes that they've had to implement, but it's a firm we follow very closely. We do own it in the global equity fund, and it's certainly very much on the bench, and one we're watching closely to buy for Rainmaker with the global mandate we have now.
Great, thanks very much. And unfortunately, we are a little bit short of time. And on that ESG discussion, I know you wrote quite a substantial piece on Santam, which has drawn quite a bit of attention in the wake of COVID. So if those listening can afford that third quarter commentary on Santam and your view on that. Unfortunately, like I mentioned, this is all we have time for today. And his team are always ready, available to chat to clients, whether it's about performance or the portfolio going forward. So please do get in touch with your Nedgroup Investments relationship manager should you like to chat to ourselves or Ant and the team. Like I mentioned, they're always happy to chat to yourselves. Thanks again for joining us this week. This concludes our local fund manager report backs for the week. And next week we will be focusing on our global funds. So please join us for that. And from Ant and myself and the team Nedgroup Investments, have a very good weekend. Thank you.